Hello everyone, welcome to Pinnacle's Listed Learnings webinar series. I'm Jared Brevy from Pinnacle Investment Management. This is the first of our quarterly series which will delve into the latest trends and insights in the listed products universe. As you know, today we're hearing from John Swaltz, who's the CEO of the Global Insight ETF Conference, on the major trends he's seen in the ETF space. Before we do get started, there is a disclaimer on the screen now that you should read. Chris Mayer, Pinnacle's Director of Listed Products, I'll hand over to you, and of course to John Swaltz, who joins us in the room here.
Great, thanks Jared, and welcome to listeners. John, we must have met about a year ago this time, right? At your conference, I think, last year in Miami. It was certainly a spectacular event. So I'm very excited to hear about your insights into the ETF industry. Obviously, the listeners would be familiar with the Australian market, which has many similarities to the US and Canadian market. You've been here now for 4 days, I understand?
Yeah, absolutely.
When we heard you were on the ground, we thought we'd nab you and just have you come and tell us a little bit about what's going on out there in ETF land. So I know you've got some slides for us. Why don't you get into it?
Yeah, absolutely, Chris. Thanks for having me, and Jared, thanks for the wonderful introduction. A couple things that I want to dig in today. Certainly, one is talk about the overall big trend with flows when it comes to ETFs. Talk a little bit about could that same phenomenon happen here in Australia, and then share a couple of the quick takeaways from the event that we did this past January in Florida. So if we go down, I think the first kind of headline there is no end in sight. And what we want to talk about, as I said, is sort of really where we're seeing the most amount of flows and why we're seeing that within ETFs. It's certainly been a phenomenon in the US, Canada, Europe. It's taking hold here in Australia. I think last year alone, assets were up 50% in Australia alone. But I think there's a much bigger trend and picture that's going on here. And it starts back in 2009. So you can see here on this slide labeled mutual funds versus ETF net flows from 2009. I think the important thing to remember is take yourself back to the global financial crisis and what was going on there. Folks were waking up and positions that were in their portfolio didn't exist anymore. Lehman, Bear Stearns, things like that. So investors were a little bit worried about what was going on with the markets and what direction we were heading in. But it also gave them a real opportunity. It gave them an opportunity to reset how they were building portfolios and the tools that they were using. At the time, active managers weren't necessarily performing up to where they might like to see them. So it gave investors the opportunity, like I said, to reset their portfolio. So you can see just alone in 2019, right, there was $953 million worth of outflows from traditional mutual funds, where you can see that there was over $1 billion roughly gathered by ETFs. We're going to quickly go into 2010. You can see that trend accelerated with $122 billion flowing into ETFs, with $273 billion flowing out of the more traditional mutual funds. Again, 2011, $119 billion into ETFs, $33 billion out of mutual funds. This, of course, despite the fact that mutual funds had a larger sales force, more marketing dollars, and had a head start from an asset gathering standpoint, that first mover advantage, if you will, to some extent. 2012, the playing field leveled somewhat as funds actually took in more than ETFs, but both still had a really good year from an asset gathering standpoint. 2012 would be the last time in the US that traditional mutual funds would gather more assets than ETFs, and I'll go on record saying I think that will be the last year that ever happens going forward. So if you look to 2013, again, great year for both traditional mutual funds from an asset gathering standpoint, but ETFs gathered about $33 billion more. In 2014, this is where we really start to see the hockey stick growth. So again, about $105 billion into funds, $243 billion into ETFs. So again, about $138 billion difference as far as the flows. 2015, it just starts to get ridiculous. You can see the numbers there. They speak for themselves as far as the outflows from funds, inflows into ETFs. 2016, again, it gets even worse as we really start to see this trend ramping up. 2017, it's absolutely insane. $420 $420 billion more dollars went into ETFs than into traditional mutual funds. Again, 2018, a very, very similar story. 2019, that trend continued again. So 2017 was the best year for ETF flows in the U.S., followed only by 2019. Or actually, I think it's 2018 and 2019, apologies. But the slide that you really want to focus on here is since the financial crisis. We've seen just under $200 billion in outflows from traditional funds. ETFs have gathered $2.6 trillion in that time. That's an amazing number, and again, remember that mutual funds started with a larger sales force, more distribution, more marketing dollars, and ETFs have still been able to gather quite a bit more assets than they have. One of the things that sort of is hard to believe about this, if you think about the past 11 years, for every day that the U.S. markets, trading markets have been open, $38,000 a second has flown into ETFs. That is just a staggering number, almost impossible to believe, but it's true. So you can really see that this trend has ramped up, and we'll talk a little bit about why that has taken place. But the next slide after that is sort of when will ETFs pass mutual funds for total assets under management? People used to think that this was going to be closer to 2030. More folks now think it'll be 2025 when we see that take place. But I know the numbers I've shared have been much more focused around the U.S. market, but I do want to highlight that that isn't just isolated to the U.S., this phenomenon. So European assets in 2019 brought in $100 billion in euros, and that market is now up over 870 billion euros as well, with it's up about 40% since 2018. In 2019, National Bank of Canada said that ETF assets crossed the 200 billion milestone there. Now I think there's about 205 billion, and 2019 saw 28 billion in inflows into Canada, into their ETF market. And then, as I said at the outset, the market here in Australia grew by roughly 50%, I think, going from 42 billion to 60. So the phenomenon is not just isolated to the U.S., it's not just isolated to Europe or Canada. You can see that taking place across the globe. If we take a look at the next slide, and we want to see why that's happening, we all know the benefits, right? There's lower costs, there's tax efficiency to them, there's the intraday trading capabilities, and then as they get bigger, they benefit from economies of scale. There's very few investment products where they actually benefit by getting bigger. ETFs are one of the products out there that really do benefit from scale. So as they're getting larger, they're getting more efficient, which is just helping investors. So those core benefits are really what's been driving this global growth in ETFs. There's some other things that we could point to with regulation and different things along the lines in each different region that have helped sort of spur that growth on, but the common thread is there across those markets. I guess the big question that we have here on the next slide is could this happen in Australia? If you ask me, it's very simple. The simple answer is yes, this can happen here. It is happening here. It's going to continue to happen here. So if we just take a look at those numbers, Chris, across the globe, like I said, I do think it points to a very bright future for ETFs here in Australia. So part of that is, why could that happen here in Australia? So just 4 quick little bullet points for everybody is one of the things that we see where ETFs have really that phenomenal growth outside of maybe some of these things applying to Europe is everyone here is playing by the same level playing field. So there's one regulator that basically everybody has the same settlement date, common language, common currency, all of those sort of things. So it's a very, very level playing field. That's really great for ETFs. There's a little bit of shift in the advisor broker market here that we're seeing. There's been some light shined upon conflicts of interest. There's more folks looking to leave more of that traditional brokerage style and build independent advisory practices. That really helps spur growth in the U.S. quite a bit. We're seeing that same trend start to unfold here in Australia. Regulations, whether you want to look at Europe with MiFID, the U.S. with the fiduciary rule. Here we just talked about really quickly the conflict of interest. All of the regulations that are being put in place now generally shine a spotlight on fees or hidden fees, and people are starting to get a sense of what they were once paying. ETFs offer a cheaper alternative in many cases. So through those regulations, it really is helping to push the use of ETFs further. And then what I mean here by dominant products is The passive products tend to lead the charge first. So in the U.S., you still see a ton of flows into the big, large, broad passive funds. You see that here in Australia. You see that in Europe. You see that in Canada. But what that really does is that's just sort of priming the market to take on more of the complex products, so the non-transparent active ETFs that are transparent, long-short strategies, factor products, all those sort of things. It starts with that core understanding of what an ETF is and using passive. And then once people get comfortable with that, it tends to open them up to other ideas, and they start to separate the investment approach from the wrapper. And the ETF wrapper is really what becomes the really cool technology, and is really what is facilitating all of those great benefits. So if the strategy makes sense in a mutual fund, it should make some sense in an ETF. You just get to take advantage of a cooler, more technologically advanced wrapper. I don't know if I can say cooler, but it's certainly advanced technology. So that's why we think it could happen here in Australia. We don't think, we believe it will happen here in Australia. So why don't we just jump quickly into the key themes? I know we want to leave some time for Q&A, and we're probably already running behind. So 3 themes popped out quite a bit this past January. The first is that the ETF market is evolving, and what we mean by that is you still have your big, large passive products, and they continue to see tons and tons of flows. But what you see is specialization, and what I mean by that is there's firms now that are coming in and focusing on one particular area. So an example in the U.S. might be a firm like KraneShares. They spent a lot of time focusing and building out their product suite in and around China, whether that be One Road, One Belt, whether it be their K-Webs product that's looking at technology and the internet in China and those sort of things. But the reason that they've had success is they've been talking one story, one investment thesis, and they do it very, very well. So there is some space for those sort of thematic and niche players. So that's evolving the way that people are thinking about entering the ETF market. You can't compete now on an S&P 500 fund. The cost is just so low from the large providers that there's no reason for someone to compete against SPY if you're entering the market now. It's the biggest, largest liquid ETF out there. Why would you want to compete at that, especially when it's at 5 basis points right now from that standpoint? So you're not going to benefit from that size or scale when you're a new entrant into the space. So you have to find an area that you can penetrate the market with a different story that makes sense for investors in their portfolio and provides them great access. Another firm that's doing really well in the U.S. is Defiance ETF, and they're focused on next-gen technology, and they're really talking to advisors about how this is going to change, how people use technology in the future. You want to be invested now, not after these technologies take place. So they're able to compete against the big, large advisors because they're finding those niche markets. If we go to the next slide here, active ETFs are coming. Apologies that this slide is a different color, but I want to make sure everyone can see the logos that are out there. So there's actually 5 firms that are doing this. The New York Stock Exchange has a non-transparent active product. Fidelity has one, Blue Tractor, American Century, and T. Rowe Price. They've all filed and been approved. None have actually launched yet within the market. Most expect American Century will be the first to get into the market. I think there'll be a bit of a gap before we see mass adoption. There'll be sort of a few that are happy to get in first and lead the way, but I think it will take some time before we actually see the products truly take off in the U.S. just because it's not something that people are necessarily that comfortable with in the ETF wrapper yet. But I do think once they get out there and they realize that the strategies that they like are now just in an ETF, they'll be very, very comfortable with it. I just think that it's going to take some time to get those that have traditionally stayed with mutual funds to understand why the strategy has moved to an ETF wrapper and why it's a benefit to them and their products. So that is going to change the ETF industry going forward. I know that you guys are looking at the non-transparent here and have a few in the market as well. So you're actually ahead of the U.S. From that standpoint, which is great to see. It's good to see that innovation is coming from other parts of the market. And then the other quick trend on the next slide is the rise of fixed income ETFs. $135 billion in U.S. dollars flowed into them last year. They kept up with equity ETFs for the first time, which is great. And there's a couple reasons that people are using them. I think the first one is the diversification aspect of it. If you're going to go out there and try to source individual bonds to build a big, broad diversification bond portfolio for your clients, that's going to take a lot of money, it's going to take a lot of time, and it's going to take a lot of your resources to do that. I think advisors and institutional investors are waking up to the fact that they can place one trade now and they can get that diversification. There's enough products out there that they can pick and choose where they want to be from a credit quality. They can pick and choose where they want to be from a duration standpoint. Again, they know that they have liquidity when they need it. Every advisor always thinks they have the best relationship with their bond trader, and they get the best pricing all the time, but you don't. The PIMCOs, the BlackRocks, those are the folks that get the best pricing. It's not the individual advisor selling one of his clients' bonds for $20,000. You're not getting the best pricing. So I think advisors are waking up to the fact that they don't need to have individual bonds. If there's features that they like about that, they can find it now in an ETF. So if you like that bonds mature, they have the bullet shares that have target maturity dates. So just like any traditional bond, on X date it will mature, and you receive your principal back at what the ETF is trading at that time. And you can take that money and roll it in to the next year, so on and so forth. So you have the tools to build out bond ladders, like I said, get into whatever sort of sector or area of the fixed income markets that you want to be into, whether that's munis, whether that's international, whatever it may be, emerging market debt. The tools are there to do that in a fixed income ETF now, and people are just realizing that it's much simpler, much quicker, much easier than it was to try to do those with individual bonds. And then I have two quick bonus takeaways for the audience. And this is more on the advisor side. So we're seeing more and more that you just can't be an investment advisor anymore, meaning that you need to be developing wealth plans for folks. You need to be a part of their life. You need to be sort of their financial coach. If you're not, basically stats are showing that 40% of the next generation, when they receive the assets from their parents, from the boomers, are going to fire their advisor. The only way that doesn't happen is if you become ingrained and sort of part of their lives and make sure that they are achieving their financial goals. And part of that is making sure that you get the kids involved, where traditionally they spent most of the time talking about portfolio construction and what they were doing with their portfolio. That has moved to the back end of the conversation. They're spending much more time talking about how they can become sort of a financial wellness coach to their clients and those sort of things. And there's a lot of tools and technology that's helping them with that. And then the last one is there's a much more of a focus on trying to differentiate your practice through building online presence. So there's been a couple of different firms that have had a lot of success with this. So not that it's a copycat industry, but I think folks are realizing that there's other ways to prospect for clients. It doesn't have to just be sort of asking the guys that you play golf with or the book club or whatever it may be. There's sorts of other ways to go out there, get your brand, get your message out there. Social media is a great platform for that, but it's ripe with pitfalls for folks, so it's a difficult thing to do. So advisors are going back and forth trying to manage what they can say from a compliance standpoint and what allows them to sort of be themselves online and attract those folks that would be interested in what their messaging is and their approach to investment. And those were the takeaways. I know we rushed through that there in quite a bit, but that's sort of the takeaways that I would have from the conference, as well as sort of that bigger trend that we're seeing along the lines of ETF growth, which is exciting because we know that investors are better invested saving money, and when you can save money and put that back into investments, we all know investors do better.
Well, thanks, Chris, and thanks, John. Great insights. I guess hearing so many perspectives from so many different people all around the world must give you a real unique vantage point of the industry as a whole. So we'll take any questions any listeners might have for John or for Chris.
Maybe while we wait for those questions, John, you've, as I said, you've been here now for 4 days, your first trip to Australia, so welcome. As you look into your crystal ball, if you had to predict how you think the Australian ETF market is likely to develop over the next 5-10 years from what you've seen in other markets at this sort of early stage of their ETF life, what do you think we're likely to see coming up?
Well, I think first and foremost, we're definitely going to continue to see the growth. I think you'll see a lot of innovation from the product standpoint as well. Like I said, you guys have had the non-transparent active first. So I think you guys might even be some leaders in that space. And I think you'll see that area of the market grow as investors understand that the wrapper is really exciting there. But again, that sort of level playing field and all those things that I point to first just really get me excited that growth is going to continue here. I know that there's exchanges out there that are working on better technology to make things more seamless, more efficient. All of those things, that technology impact is going to be great. Just really allow this market to blossom. And then it's just a matter of sort of getting that word out to investors around the benefits of ETFs and what it can do for their portfolio. But I think when we sit back here in 5 years' time, I would be shocked if this is not a $200 billion market. Maybe not in 5 years, but certainly I would think if we sat here in 10 years, I definitely think we'd be well over the $200 billion mark by that point. But again, I think expectations are for something around 15 billion, 20 billion this year of flows into it, so that gets you to 75, 80. So you're on that projection up to that 200 billion mark and beyond.
We do have a question here from Cameron for you, John. What do you think of ETF prospects in the liquid alt space? It's been a tricky hunting ground, even in the US.
Yeah, so I think the liquid alts are definitely interesting because sometimes you're trying to take some strategies that might not work perfectly and sort of fit them into the ETF wrapper. I think you're going to see more product innovation in and around that space. It's not necessarily related to ETFs per se, but we do have conversations with custodians in the U.S., and we know that they're trying to open up private equity markets, private credit markets to investors. So you may see some stuff where investors are moving away from liquid alt ETFs and looking at other alternatives for their exposure, but it has been a bit of a tricky road for the alt products just in general. I think one thing is they tend to be more complex as well. You have to remember that a lot of times the end user of these in their portfolio is a retail client, perhaps my mom. If she sat down with her advisor and he started to talk about why they're using a liquid alt and what it's supposed to do, she would just turn off and have no idea what it is. So I think a lot of times advisors are going to, from an advisor standpoint at least, struggle to explain them to their clients. Those that understand how to use them and have some clients that trust them are definitely seeing the benefits of them as a hedge in their portfolio. And you would think now would be the time, maybe before Monday would have been the time to start to look at those as hedges to your portfolio. But yeah, the liquid alt is definitely tough sledding and a tricky proposition when it comes to ETFs.
Another one here, should advisors be wary of any ETF offerings in market niches where alpha is difficult to find above a certain capacity? Aussie small caps come to mind, as do some alternative strategies.
I don't think you have to be aware of the ETF. You just have to understand what you want to use that ETF for. So if you're saying that, look, we don't think that managers can drive alpha from a certain sector, then you certainly want to use an ETF in that sector. If you think there's an area where there's real opportunity for an active manager to outperform, that's where you'd want to look at the active manager. I would almost flip that question on its head and say, in the areas where you think it's hard to find alpha, go cheap with beta, get the exposure to the market because you're going to overpay for something that you may not ultimately get. Go pay for where you think they really have the opportunity to outperform, and think of it sort of in the reverse fashion.
John, and one thing we hear a fair bit from investors is ETFs are driving the market bubble. Everyone's piling into ETFs and that's driving the market up, and it's all going to end in tears when the markets turn. What do you say to people who make those kind of comments?
So I understand what they're getting at, but if you look at sort of the overall size of the ETF market globally, it's such a fraction. So it's not actually leading to market volatility or any of those aspects. What you have to understand when you're investing in an ETF is that you're investing traditionally in more of a cap-weighted strategy. So yes, as markets go up, as people are putting more money into indexes, is it to some extent, driving markets higher? No, I think people are chasing returns. They see the markets are going up. They want to be involved in it. It's not the ETF that's doing that. Let's say it's more investor behavior than anything. And when the markets come down, well, ETFs are designed to track the market. You have to understand that the ETF is going to fall with the market, but they're not going to cause more of a sell-off just because you're in an ETF. Sure, you have the ability to be liquid, but if you're in a traditional mutual fund, if the markets go south, you can decide to sell out of those. That's going to add to the sell-off. It's not the ETF that adds to the sell-off. It's investor behavior that either pumps up a bubble or causes a mass sell-off. It is not the ETF at all.
And how about, similarly, investors might say ETFs are unproven in a market correction? What would you say to that?
I would say that's absolutely not true at all. So there's a couple examples, and you can point them, they're a few years old, but when the tsunami hit in Japan, ETFs were used as price discovery there, and people were able to price that market more accurately there. After 9/11 in the U.S., when ETFs came back online, they were used for price discovery. So in times of crisis and those sort of things, ETFs actually do better, and people turn to them more than they would in sort of normal times from that standpoint. It's one of the reasons bond ETFs are taking off. People are now using them as the proxy for true pricing for bonds, and are saying, well, if I understand the pricing through the exchange, why do I want to try to go and sell the individual? So, no, I think in times of crisis, the ETF is actually a benefit to owning your portfolio. You know, I mean, obviously you could point to, you know, market risk when you're on an exchange. There are those aspects to be aware of, but just like the flash crash, if you own American Express just as an individual name, that was hit quite hard in the flash crash in May of 2008. I'm sure, I don't know if everyone's familiar with those. But the ETF, everything corrected when the market corrected. It wasn't the ETF, again, that caused it. That was market structure. The ETF just happened to hold a basket of those names that were affected by the flash crash. But keep in mind, if you held a traditional fund and the markets didn't rebound, at the end of the day, your NAV would have been set to where those closing prices were on those individual stocks. So it's sort of like going to the doctor, him not telling you you're sick until a day later, right? You want to know sort of, well, the reason you're at the doctor is I want to know right now and here that I'm sick. All the ETF is doing is just shining a light on that so you know real time. But any of those things that sort of people say, oh, they do this, they do that to the market, if you own the traditional mutual fund, it's going to be reflected in your NAV at the end of the day if markets are up or down on some wild swings. So it's not, again, not the ETF. The ETF is just showing you in real time.
And we do have another question here from Cameron. How far are we from cost-effective direct indexing? Is that a longer-term threat for ETFs, thinking of things such as OSAMs, Canvas, or Motus?
Yeah, so Canvas, familiar with that product, and Parametric, and some of the other Ethic and a few folks that have been around. So Parametric has been around for, I think, 20 plus years or so, doing direct indexing, so it's not a new and novel thing. What I think is really exciting around direct indexing that people like is the technology, so stuff like Canvas, where you can sit down with your client and really start to have a conversation about what they want to be invested in. I think what people are forgetting about that is that there has to be some bands on that. So Chris, we talked about this at dinner last night, right? If John Swolz was picking the names that he wanted into his portfolio based on sort of my love or hate of things, my returns are going to be abysmal. You're gonna you know, get a skew of the market and those sort of things. So I think it's an interesting tool. It's just going to have to be used in the right hands. But we had a session on direct indexing in Florida. And surprisingly, direct indexers think that ETFs and direct indexing are a complement to each other. And I tend to believe that more, that maybe you have some certain situations where, let's just say up in the Northeast in Seattle, someone works for Boeing as an example. They may have a ton of Boeing and that sort of stuff. So you want to build a portion of their portfolio in the U.S. that is not going to have any more Boeing in it. So you build them a direct U.S. related sort of portfolio. But then you're not going to go out and direct indexing your international exposure, your bond exposure, and that's where the two complement each other. You still use the ETFs to go out and get that broad exposure. But direct indexing, I guess, sure, if you want to think about it as a threat, I guess you could. But like I said, Parametric has been around for 20 years. If direct indexing was going to, you know, just take the world by storm, you would have thought people would have caught on to that a little bit sooner. And again, direct indexing is it's a fantastic tool, but can be a complement to ETFs, and vice versa.
John, maybe one final one from me. You know, you've obviously got some insights now about the Australian market. What would you say has been your biggest surprise coming here and speaking to a bunch of ETF folk relative to what you maybe thought about this market before you arrived here?
It's probably more of a pull at the heartstrings type of an answer. The passion down here for everyone's business and what they're doing is really exciting. Reminds me of the early days when I was at iShares and we were sort of taking the world by storm, and we were going to, educate everybody and let everybody know that what we were doing was great. There's that sort of disruptor, challenger feel down here, which is really nice to be a part of, and some of the reasons that we're attracted to this market, so the real passion for it. And then I was really surprised at how much of it has been done internally. So there hasn't been, not necessarily, I'm sure there's been support from outside and stuff like that, but a lot of the plumbing and a lot of what's been done has been done internally here to build the market in your eyes and in your light, where I thought it was going to certainly be much more of like larger product providers coming in and just saying, this is how this is done because it's worked everywhere else, where that doesn't seem to be the case down here, and I was pleasantly surprised to see that.
Well, if there are no more listener questions, that brings us to an end. Anyone who does want a copy of this webinar, it will be posted on the Pinnacle Investment Management YouTube page, the Pinnacle A-Shares website, and the Pinnacle A-Shares Facebook page. Thanks everyone for joining us.
Thank you for having me. Appreciate the time.